Hey traders, this is my recap for the week ending October 23rd. So the first trade that I took last week was an AMD. I opened it on Monday. I sold the 81.5 strike expiring that week. I got a credit of 1.01. I closed it for 32 cents. That's an overall profit of 69 cents, and that was for $690 because I did 10 contracts. As you know, AMD did drop on Wednesday. It dropped below the 81.5 strike. I didn't roll the trade because I was expecting AMD to come back up, being as they have earnings this week on Tuesday. So I thought that there was a good chance on Friday that it could recover and run back up above my strike. But even on Friday, at one point, it was still below my strike. So I thought I was going to have to consider rolling or looking at taking an assignment. Now, as you guys know, normally I always would roll my position, but I was considering taking an assignment because I wasn't comfortable having the 10 contracts that I had on. Normally, for a credit this size, I would only do 5 contracts. So based on the margin it was taking up, I wasn't comfortable rolling AMD to the following week. And it being an earnings week, I just wasn't comfortable having on those 10 contracts. So I was either considering closing out a few of the contracts and rolling more like 5 or 6 contracts, or take assignment and then hope that AMD stock did go back above 181.5 before the earnings announcement Tuesday. So that was really what I was planning to do. If it hadn't have recovered above my strike, I was going to take assignment and then hope that on Monday or Tuesday, the stock went back above 81.5. I could just close out the stock and be done with it. In the event that it did not go above the 81.5, I would have sold the stock and got back into the puts, going ahead and rolling it down to a lower strike price, probably for fewer contracts than the 10 that I had on originally. But I didn't have to worry about that because it did recover back above my strike. I ended up closing it out throughout the day. I closed like 1 contract in the morning, closed 2 a couple hours later, and then closed the remainder later in the day when AMD did move back above my strike. So my net closing cost out of all 10 contracts was the 0.32. BA was another one that I put on that Monday. I sold the 165 strike. I got a credit of 1.58, closed it for 0.47, profit of 1.11. I only had 4 contracts, so that was $444 profit. Amazon was a spread that I put on that Monday. I sold the 3110, 3105, put credit spread for 97 cents. I closed it for 15 cents. Overall profit of 82 cents on 10 contracts, $820. This is another one that I did more contracts than I would typically do for the credit I receive. Usually if I'm getting that size of a credit, 0.97, I would do more like 5 or 6 contracts. But with Amazon having earnings coming up this week, I thought the stock should probably hold up well. Midweek it did drop fairly close, but luckily it recovered on Friday and was high enough above my strike prices where I could close it out and get a really nice overall profit on this one. Netflix, this was the earnings trade. I did a Jade Lizard, so I sold the 477.5 put, and then I had on the 530, 535 call credit spread. I had a net credit of 5.21. I closed it out separately. So initially I closed out the call credit spread the next day and then waited until later in the week to close out the put. Combining those two together, I closed them out for 0.69, and that gave me the overall profit of 4.52. I only did 1 contract on this one, so that was $452 profit. I have another video that I made last week explaining exactly what a Jade Lizard trade is and how I put on this trade. So if you are unsure what this trade is, you can go back and reference that video. Lastly, RKT. This is one I've been in for a while. I got assigned shares of RKT a few weeks ago at 24.5, and then I was doing cover calls against that. So you can see I collected some premium selling calls. But what I decided to do was close out that call. I closed it out for 2 cents. And then I entered what's called a ratio spread. I entered the 20.5, 22.5 ratio spread, expiring 11/6, and I got a credit of 4 cents for that. And we'll talk about what a ratio spread here is in just a second. So my overall profit for the week was $2,406. You can see the only trade that I had left was my RKT trade, and I did add 1 new trade for this coming week in Chewy. But you can see right now I would take about a $2,000 loss if I were to close out my RKT trade. I'm down $2,700 on the stock, but I'm actually up on my ratio spread right now of 740. So I could have still closed out this entire position and still had a profitable week. I still would have been up almost $400 this week, even by taking that loss. But I'm going to stick it out and wait because RKT's earnings comes out, I believe, on 11/10. So my hope is up into earnings, the stock will rally and at least go up to 22.5 or higher for me to be able to close this trade out for max profit. So let's take a look real quick on what a ratio spread is. So as I mentioned, currently I was assigned stock at 24.5 and I have 1,000 shares. So basically what a ratio spread means is that you have a spread with different contract sizes for each leg. So this is considered a 1-by-2 ratio spread, where for every one contract that I'm buying, every one contract that's the long call, I have 2 that's on the short call. Since I did 10 contracts on the long call, I'm having to sell double of that on the short call, and that's what makes it a ratio spread. If we had the same contract sizes here, it would just be called a vertical spread, like the typical spreads we do, like credit spreads and things like that. But since the contract sizes are different for the legs, this is when it becomes a ratio spread. And you can see that for the 20.5 strike, I had to pay $1.22, and then for the 22.5 strike, I received a credit of 0.63. But again, I have double the contract size, so actually that gave me a net credit of 4 cents when you subtract the two. Now we could actually break this trade down into its components, where let's split out this 22.5 strike into 2 separate trades, 10 contracts each, so that we have 10 contracts for each leg. So you can see over on this right side, I have the 20.5 strike, 10 contracts at 1.22. It's the long call. That stays the same. But now I've broken out the 22.5 into 2 separate entries, both having a minus 10 contracts. That's basically meaning I'm short at 0.63. So now we can actually group these first 2 together, because now they're like for like. They're both 10 contracts. And this would be considered a debit spread. So a debit spread is when you buy one strike price and you sell a higher strike price, and you have to pay a debit for that entire spread. So normally a credit spread, which is what we typically do, is the opposite. You're selling a strike price and then buying a higher strike price, and you have a net credit. Now we're doing the opposite, where I'm buying the lower of the 2 strike prices and I'm selling the higher 2 strike prices, and that gives me a net debit. This debit spread would cost me $590 because I'm doing 10 contracts. 10 contracts times the 0.59. Then we have a short call, because those extra 10 contracts we're selling at 22.5. We're also getting a 0.63 credit for that, but it's a short call, which normally would mean we would have to have margin to be able to put on this trade, because it would be a naked call. But since I have 1,000 shares, it's considered a covered call. So really, when you break down a ratio spread trade, it's really 2 separate trades. It's a debit spread combined with a covered call. And you can see the math works out the same. When you consider that the debit spread costs 0.59, but the covered call brings in a credit of 0.63, it's still a net credit of 0.04. Another way you could look at this is the covered call is paying for the debit spread. So essentially it becomes a free trade for me. I'm not having to spend $590 to buy this debit spread. I'm using the credit that I received from the covered call to pay for the debit spread. And instead of having to enter these as separate trades, I don't have to put the debit spread in first and then go do the covered call. I can put it in as one trade, and that's when it becomes the ratio spread trade. So this is called a stock repair strategy. So why is it called that? Well, I was initially assigned shares at 24.5. And let's say my goal is that I want to be able to close the stock out at 24.5 so that I don't have to take a loss on the stock. Now, granted, I've brought in several credits on this position. If we go back and look, you can see when I was selling puts, I brought in 1.2. I brought in a 0.4 credit on the call sides. So when you total all these credits up, I've brought in about $1,700 worth of credits. So really my break-even price is less than 24.5, but I want to be able to keep the majority of that credit. So I'd like to be able to just get out of the stock at 24.5 so that I don't have to give back any of these credits. So that's my goal, is to get it out 24.5. So to do that, I have a few options. I could just sit on the stock and wait for it to come back up to 24.5, but it hasn't been up to 24.5 in a while, so I may be having to hold the stock longer than I would really like to be able to get out at 24.5, because the stock is sitting around 20.5 right now, so it would have to go up another 4 points for me able to get out at the price I'm wanting to get out at. My other choice is to keep doing cover calls, so I could keep selling calls on this, but if I did the 24.5 strike price, I wouldn't really get that big of a credit, so I'd have to pick a lower strike price and risk getting called out of the stock at a lower price than I want to. So by doing this ratio spread, it allows me to get out of the stock at a lower price, but get the same profit or the same benefit as if I were to hold hold this until it got to 24.5. So how does that work? Well, again, we break down the trade into its two components of a debit spread and a covered call. With a debit spread, the max profit on a debit spread is the difference between the two strike prices. So the difference between these two strike prices is 2 points times the 10 contracts. My max profit on this is $2,000. Now, normally you would subtract the cost of the trade, which was $590, to figure out your profit. But keep in mind, this is a free trade for me because I'm covering the cost of this debit spread with the covered call. So really, when it hits max profit, when it gets to the 22.5 or higher, I get to keep the full $2,000 for this trade. On the covered call, I had the 22.5 strike price. That means that if the stock hits 22.5 or higher, my shares are going to be called away at 22.5, and I'm going to take a $2,000 loss because I paid 24.5 for them. So 24.5 minus the 22.5 sell price is a $2 loss. Times 10 contracts is going to be a $2,000 loss. But I'm making $2,000 on the debit spread. So essentially it becomes a wash. I take no loss on this trade, and it's just as if I had got out at 24.5. Another way you could look at it is I'm getting my stock called away at 22.5, but then I'm getting another 2 points on the debit spread. So when you sum that up, it comes out to be 24.5. So even though the stock only goes to 22.5, it's as if I'm actually getting out at 24.5, which is my goal. And this stock has hit 22.5 a few times since I got in it. So there's a good chance it could get back up to 22.5 before my expiration, more so than the likelihood of it getting up to 24.5. So if by November the 6th, which is my expiration date, if this can close at 22.5 or higher, I'll be able to get out of this position without taking a loss and keep the full credits that I received when I was selling puts and doing cover calls. Now, the nice thing too is, let's say it doesn't get to 22.5. Let's say it only goes up to 21.5. So what happens then? Well, if it goes to 21.5, I know that this debit spread will be at least worth $1 because the 20.5 strike will be in the money by 1 point, and this 22.5 will be worthless. So I will make $1 on this trade, so $1,000 on this trade. This would also become worthless, which means that my stock won't get called away. So I make $1,000 and I get to keep my stock. So I could do this same trade again at that point, or I could start selling covered calls on it since the stock has come up some at that point. So that's the nice thing about it, is that any price it finishes at above 20.5, I'm going to make a profit on this trade. My max profit being $2,000, and there's zero risk on this trade because, again, I got a small credit to put this trade on. My risk, obviously, if the stock continues to drop, I'll be losing money on the stock. But as far as this specific trade, I can't lose any money on this specific trade. So this isn't a trade I do often just because I don't take assignment a lot with my stocks. As you guys know, I typically will roll my positions, but since I did take assignment on this one, I saw this as an opportunity to use this strategy. The strategy also only works when the stock is still relatively close to the price you were assigned at. For example, if the stock was, say, at 15, I wouldn't be able to do this strategy because the stock would be too far away from my strike price. But since it's still relatively close, I was able to put on the trade and get the strike prices that I wanted to be able to give me the same result if I held this stock until it recovered. And I had to go out to the November 6th expiration to do this. I tried doing it in an early expiration, but I couldn't get a net credit out of this. The covered call piece wasn't covering the cost of the debit spread, so I kept checking different expirations to finally find the one that would give me the net credit so that I didn't have to spend any money to put this trade on. So as I mentioned earlier, other than RKT, the only other trade I have on is Chewy, the one I put on Friday. We have a lot of earnings coming up this week. So here are the most popular companies that are reporting earnings this week. You can see we've got Google, we've got Microsoft, we've got Etsy, we've got Pinterest. Those are ones that I've been trading a good bit. Boeing, Amazon, Apple, Facebook, Twitter. So a lot of stocks reporting this week. So if I do any trades, I may just do some earnings trades. I don't anticipate putting on a lot of trades this week, again, because of the election coming up the following week. I want to have as much cash as possible in the event we do have a pullback in the market. I want to have enough cash to go on and put in some new trades. So I'm not sure which of these stocks, if any, I'm going to play. I really won't make the decision and probably until the day of, because normally if I'm going to play earnings, I like to play it on the day the earnings is going to be reported. So if it's after the close, I would put it on, in this case, say Tuesday. If it's after close on Tuesday, or if it's before the open on Wednesday, I would also have to put it on Tuesday to be able to get my trade in before the earnings came out. If I do any of these trades, I'll make sure that I obviously send that out in my email alert. So that's all I have for this video. Hope you guys have a good week. Thanks.